Hey everybody, Alan Brochstein from 420 Investor and New Cannabis Ventures, and I'm here to preview our weekly newsletter that'll go out on Sunday, March 27th. Before I get into that though, what a fabulous week. This is our second straight rally. It's kind of silly if you ask me the reason for it, but hey, it is what it is. And the good news is this rally's starting from very depressed levels. So I'm not going to tell you exactly what I think about where the market may or may not be going, but I will say, as silly as it is, because I'm definitely on the record saying that the MORE Act passing the House of Representatives isn't in and of itself a big deal. Already done that once. Still could have some legs. We'll see. But the market rallied almost 10% this week. That was on top of a more than 6% rally in the prior week. It leaves us down 9.2% year to date still. That's not that far off of stocks in general. It's been a tough year. I'll get more to that later. But the rally off of the March 14th low is now 22%. So the week had a lot of news. So most of it that we published will make it to the newsletter. Some of it was really big. And again, we publish press releases around usually capital raises, M&A, and financial reporting. And we had, I don't think we had capital raises this week. We had a lot of financial reporting and then one big piece of M&A. So let's talk about that first. I have to admit, I'm in the camp of people caught a little bit off guard by this. What we've been suggesting at New Cannabis Ventures is the M&A is going to be a big thing. But most of it's going to be larger companies buying private companies for the most part. We've seen some exceptions to that. And I think, I kind of softened my view when Trulieve announced the Harvest acquisition. These deals are really tough with all the different rules across the states and all that. And so the Columbia Care Cresco merger, which was announced at the same time as Cresco was reporting its Q4, this will be the largest deal to date if it closes, right? It's not supposed to close till Q4. It's an all-stock deal. And I will say this, a lot of people, and I'm not going to name names, but some very interesting people reached out to me, thought this was like a negative for the industry. And they suggested, the low premium for Columbia Care, which has been perennially cheap. I mean, it's been really cheap. It's not the only cheap stock. There's other cheap stocks, but it's been trading cheap for years. And so I don't think Cresco did this to buy a cheap stock, but they did. They got it. No, the deal's about optimization. And I told my subscribers at 420 Investor a lot of positives about it. I'm not, so in favor of these big deals, honestly, but there are a lot of positives here for the two companies, and this will get Cresco into some new states of interest, New Jersey, of course, as well as Virginia on the East Coast. And then on the West, Cresco has no presence in Colorado, so it will give them that as well. It also strengthens their position in California, where Cresco had really stood out as one of the few MSOs willing to put more than just a toe in the water there. So that was really some big news on the week. I think it was met with a mixed reaction. I'm actually kind of positive about it. Not necessarily that it'll trigger more M&A, but I think it helps rationalize the industry a little bit more. And I'll leave it at that. The rest of the news, actually one other M&A was Aurora. And they did a kind of like a copycat deal of Organigram, which was announced earlier this year when Organigram bought Laurentian. And so they're buying Terra Pharma. Terra Pharma is not in Quebec like Laurentian, but it's the same idea. You buy a profitable, smaller private company that's focused on premium. So they're paying $38 million before earnouts for that. So that was interesting. And then the rest of them, I believe, were all, I'm just double checking. Yeah, we're all financial reports. And this week's going to be really busy we're not wrapping up earnings season because companies are listed on the CSE like Verano, for example, that hasn't even given us a date yet, they can wait all the way till the end of April. And so there will be some reports in April, but kudos to these American companies, by the way, that uh, some of them that didn't have to file until April did step up, and so we've seen some um, improvement in that delay. The fourth quarter, 4 months, that's ridiculous. By the time you report, if you wait till the end of April, you're already a month into Q2. It's ridiculous. So anyway, we were busy this week. Agrify reported. It was disappointing. They missed on their revenue and their adjusted EBITDA, and their guidance was light as well. That pushed the stock to a new all-time low before it rallied late in the week. Charlotte's Web also disappointed. Although they grew revenue 5% sequentially, it was down from a year ago. So that was a little bit disappointing. That CBD space is really tough. I did listen to the new CEO on the call, and that was kind of one encouraging aspect of an otherwise not so exciting report. 25 million. It seems like they've been stuck at that level for 2 years now. And then Columbia Care reported, I think it was the day after, maybe 2 days after the announcement. And their quarter, again, well, they had pre-announced it was in line, but their guidance was really light, really light. Not that that's unusual. We've seen a lot of that, right? So it didn't really stand out. Similarly, Cresco Labs, they missed on their revenue, and their revenue increased just 1% sequentially. They took some actions in California that they had told the market about ahead of time to do away with third-party distribution, and as a result of that, that knocked off 5 points. They would have been up 6%, they said otherwise. But still, the outlook there doesn't seem that strong. So just continuing the trend of what we've seen with margin pressure and lighter revenues. They didn't give formal guidance, though. So the next one is Jushi. Again, it's the same thing. A little bit light, guidance light. Their revenue was a record 66 million, up 22% sequentially. And then the last one's Canadian, Nova Cannabis, a retailer. This was spun out of Alcanna. Alcanna still hasn't closed their deal with Sundial. And we were supposed to interview, again, Nova Cannabis. We interviewed them once. I find it to be very interesting. It trades maybe about 500 shares a day in the US, maybe 1,000 in Canada. I don't know exactly in Canada, but it doesn't trade. And it's a stub, so it's going to be hard for people to invest in it, I would imagine. And I'm kind of curious what happens to it after Sundial, when they close Alcanna. But anyway, Nova's revenue increased 23% sequentially, and they're not the only ones, but they're one of the companies really pushing down pricing at the retail level with the value strategy. And I talked about High Tide's report recently, and they're engaged in that as well. They go about it a little bit differently, but it's kind of interesting to see what's going on in that Canadian market, in that Nova Cannabis value bud strategy. They're not the only ones, like I said, but very interesting event. I actually think that strategy can be very helpful to the overall market because what it does is they're not necessarily competing with other retailers. They're competing with the illicit market, and by having that very low pricing for everyday kind of cannabis product that's going to appeal to the everyday user, that's their target market. So we also each week do our we have our proprietary content. This week it was limited to, next week it'll be really busy, but this week it was limited to 2 interviews, and those interviews were coincidentally both out of California, and I think that's kind of interesting actually. We've seen some of the California related stocks really bounce. They got beaten up so badly, and people have written off California. So it was really interesting to listen to both these interviews and what these 2 companies are doing and how they see the market shaking out. One of those companies we re-interviewed, or I guess interviewed again, Gold Flora. Lori Holcomb is leading that company. They've done some M&A recently, which we talked about on the interview, and they really seem to be moving at lightning speed and doing very well in California. It's a great interview, and it always makes me feel good when we interview somebody and they come back 6 months later and the story sounds even better. Because we haven't seen a lot of that in California. And then the other one was a new one for us. You may recall that Harvest was going to buy Falcon, and Falcon is a California-only operator. The deal fell apart. It went to litigation, and when it was settled, and I had forgotten about this, but TrueLeave, which bought Harvest, now owns 9% of this company, and the company is run by, the CEO is a former Harvest senior exec. And so we interviewed him to learn a little bit more about what the company's doing. He talked about how, the last 3 years they've done 100 million of revenue each year, talked about how they're profitable. Very interesting. So unlike Gold Flora, which is vertically integrated, where she talked a lot about what they're doing in retail, this is just, he defines it as a CPG play only. So a lot of different ways to play in California, and these are two very different ones, but two companies that claim to be profitable with high levels of revenue. So that was pretty much what the news items that will go into the newsletter. But each week we also try to share some of our thinking. And this week, maybe a little bit different. I think you have to understand, I have some fine lines to walk in my life. So first of all, as you're probably aware, New Cannabis Ventures works with several publicly traded companies. We provide investor dashboards to them. We never tell people to buy their stocks. I mean, literally, we never do that. And we're not ever going to do that. But that's one thing I have to be a little bit careful about. And then I also run 420 Investor, and I have people paying me money for my ideas. So I don't want to give my ideas away for free. But I will say this is pretty darn close. And not that I necessarily said to buy anything, but I talked about something that I find very interesting. So, anybody that's followed me knows that I pay a lot of attention to the balance sheet. Obviously, there's a lot more to a company than its finances and than its balance sheet, right? There's a lot to a company: the culture, record of success, leadership. There's a lot of things you have to consider. The valuation of the stock. So I don't want people to think this is the only thing I look at, but I've been looking at balance sheets for a long time, and this year has not started out the way most of us would have expected, right? Who would have thought we'd be on the edge of World War III potentially, and inflation, Fed tightening, maybe some of you anticipated that properly, the overall stock market doing poorly, and especially growth stocks. So a lot of challenges this year. And so early in the year, I really started to refocus or focus more intently on companies that had really strong balance sheets. And in the process of doing this, I've come across some new names as well, but even some of the old names. And I guess what I was trying to do in this piece this week, which you can read tomorrow, is talk about some of these companies that have no debt whatsoever, and they have substantial cash. And they tend not to be MSOs, unfortunately. And there are some in Canada, which I mentioned, and there's a lot in the ancillary space. And so I think this is a really interesting idea. These names can be very defensive in the sense of, in challenging times, having that cash can be very helpful. And I talk about that in the piece. So having cash, so one thing that can happen is investors don't properly factor that into their valuation. So sometimes these stocks can actually be undervalued. But there's more to it than that. Companies that have a lot of cash and no debt, they're going to be viewed more favorably as potential M&A partners. They are viewed more favorably potentially by their customers or strategic partners. Imagine, a company out there has a really good brand and they're looking for a partner. Who are they going to partner with? Somebody up to their eyeballs in debt, or somebody that's got a lot of cash, strong balance sheet? So I think that's it. We've actually seen at least one company, maybe a couple, repurchasing stock. You can do that if you have cash. And so I think I've pretty much mentioned most of them, if not all of them. So that's what we talked about this week. I urge you to take a look at the newsletter tomorrow when we publish it, if you're interested in some of the names that we actually discussed. So with that, I'll sign off, and we'll hope for another big week. Take care, everybody. Have a good weekend.